Futures trading in crypto is the fastest way to get rich, and it is also the fastest way to go broke. If you are a trader and you use futures or leverage positions, and you are in a high risk atmosphere. But what you can do is you can use certain things to make it easier on you. Now, we're not here to talk about that. We are here to talk about how to do a leverage trade, or what it is that you're doing. And for that, I have two partners. Up here, I have KCEX, and down here, I have Weeks. I have two futures set up on each one of those, and I'm going to take you through the process. If you like this type of content, make sure you hit the like button on the way in. The best thing you can do to help me, by the way, is sign up at the description down below. And if you're going to do futures trading, start with KCEX or WEEX. That choice is up to you. Let's go. Okay, so this is your page for KCEX. KCEX is a non-KYC exchange. What they do and what they provide you with is a safe platform that doesn't require KYC. KYC means know your customer, and what that means is they want your identification. Now, you cannot cash out from KCEX, or you cannot cash out from Weeks. You actually have to move it from your crypto wallet on this exchange into a crypto exchange that you are KYC'd with in the United States in order to cash out your crypto. But fundamentally, you have a centralized exchange here that does have an opportunity for you to do futures trading without the government and Big Brother watching over you. So how do you do that? Well, there's two different ways. You have market and you have limit orders. Now, to simplify this process, if you have decided that you want to buy and you think the bottom is in on an asset, in this situation, Bitcoin, then what you could do is use your available USDT, which everything would have to be converted to USDT. I've already completed the trade right here, and we put $200 into it. The margin on it is $192, okay? But you take your USDT on market price and you slide up here, and then you decide whether to open long or open short. Now, before you close that transaction, the most important thing is to figure out whether you want to do an isolated or a cross. And you can see here, there's isolated or cross. Now, in an isolated margin, it means that my $200, that's all the risk I'm willing to put up. So everything about this trade is based on this original margin, less any kind of fees or anything like that, and how much the market pumps or dumps. It's very simple. If you use a cross position, then it will use some of your excess funds that you have not put into this position to cover your margin until you're at zero. So it's protection in case the price goes down. So if you have, if you do this margin for $200 and the price goes down to where you're about to get liquidated, your cross margin will pick up some of that, and it will add some of the money that's in your wallet back in to help you prevent loss. Now, that will also drain you, so be very, very careful when deciding how you're going to explore your risk. Also, the amount of leverage goes from 5x to 100x. Now, the way that this works is very simple. When I gave that $200 to KCEX, I decided I was going to do a trade at 5x leverage. And you can see that confirmed right there, 5x isolated. Now, what that means is I borrowed 5 times the amount of money that I put in. So I put in $200. So I basically borrowed $1,000 from somebody, and they're going to get a profit. They're going to get a cut off of my winning. Whatever, if I win and I take a profit on this, then they're going to get a part of the fee that's being charged by KCEX, okay, for the transaction. And that's how they pay them. That's how you earn yield off of staking. So they are loaning you some crypto in USDT to buy a crypto. Now, my position, the only loss that I could really incur is $192, okay? So if I'm using 5x leverage, I mean, here's basically what you're looking at. Take your margin and divide it by that number, and that amount that you come up with. So if it's 5x leverage, you take 200 divided by 5, which is 40, right? That means if the price of my asset goes down $40, I'm going to be out. I'm going to lose. If I get completely liquidated, if my amount goes down below what amount I put up, then I will immediately be liquidated, and then that money will be given back to the people that borrowed. Now, when you're going long, what you're doing is you're basically buying an asset and selling it at the top. If you're shorting, then what you're doing is you're getting 5x worth of USDT and you're betting on the price to go down in order to fill that order. That is to say, if I got $1,000 and I did it if I use $1,000 in 5x leverage at 87,428 at the top up here, then I borrowed $1,000 with the idea that I'm going to buy down here. And then when I buy that, I will have completed the order. Either way, I'm buying crypto, right? So long or short, that's a choice that you have to make. If you think the market's going up, you go long. If you think the market's going down, then you go short. Now, along with that, once you've made the transaction, you are then tracking it. Now, I'm up right now 24.7% on this 5X, and that means that my profit right now is $47.64. And what I've done at this point is I've set a take profit at $104,000, which would be a profit reward of $262 if, in fact, we were to go to $104,000. And I do think that there is an impulse move programmed into crypto and programmed into Bitcoin where that could happen. So that's my risk, and that's what I'm taking. Now, in the event that I want to prevent a loss, then I would come over and I would add a stop loss. So my stop loss trigger price, I would look at what is my position. My average entry price was 81,738. So if I took my stop loss trigger price at 80,000, then I will have lost 10% right here. Whoops. I would have lost, that's not the right one. I would have lost 10% of my total bag. So my $200 would become 180. Basically, you're setting yourself a loss that, and by the way, setting a loss stops the eventual collapse of whatever it is that you're doing. So it's always good to set yourself a stop loss just in case you didn't get the bottom. It would be better if you bought crypto at this range right here, and then it went down even more over here, and you lose 10%, or if you bought right here, you think that's the bottom, but it keeps coming down, so you lose your money right there. If you allow it to come down to the bottom, then you're actually better by having sold at your stop loss number than if you had held on to it and that 200 became 100 and then it pumped up here and became 300. If you had stop loss right there, that would be 500. So you just have to be very, very careful in how you're doing it. Now, let's move on to the next one. And the next one is called Weeks, W-E-E-X. They have a little bit of a different setup, but as you can see with them, it's generally the same. You're going to get a trading chart, and then you're going to get an order book, and then you're going to get your ability to make transactions. Now, you will notice here that I am in a trade here for Solana. My average entry price here was 128. The market price, my margin was about $100 right here at $91. Just a small amount. My liquidation price is 104.8. It is a cross combined 7x. So if I lose any money, then that money comes out of my wallet directly. So if this were to go down to 104, then it would drain my wallet until it was at 0, protecting my margin position because I use cross. But there's not a lot of money in this wallet, which is why I did that. Now, I do think that it's going to go to 190. I think there's an impulse move programmed into Solana to move up to 190. So you will notice up there, I have a take profit set for exactly 190. And as you can see from that, that would be a 338% win. And the estimated profit on that would be $309. So it's very, very simple. If you think that a project is going in a specific direction, buy it and go that direction. If you're wrong, you can get liquidated, or you can stop loss to prevent your loss. And if not, then if you literally find the bottom, if you literally found the bottom of Bitcoin in this last bull market, which was about 16,000, if you had gone 100x and used $1,000 at that level, you would have hundreds upon hundreds of thousands of dollars right now if you had just picked the right direction at the right time and had actually caught that falling knife bottom. So that's why people do this. That's why people are looking at it, because one big win ends up changing your life dramatically in cryptocurrency. So that in a nutshell is futures trading. I know this is about as layman as it gets, but I want you guys to see that, look, we're all in this together, right? We're all in the same gang. I'm trying to make this as easy as I possibly can for you. Let me know what you think in the comments down below. It's not financial advice, but I'm always right.